So, Steve, you observe that it's a low fire, no hire labor market, and certainly the private data backs that up as well. What is your take on what traders are pricing in terms of rate cuts, not just for the rest of this year, but in 2026?
Yeah, as Priya said, the market's coalesced around a 3% terminal Fed funds rate, which largely aligns with our base case view. I would add, though, that we think there's downside risk to the policy rate, particularly as Priya laid out with what we think an underlying weakening or softer than expected economy. So as interest rates start to fall, that will start to feed back into economic growth, we think, and eventually be a ballast and supportive for growth. But for now, with the Fed focused on labor market weakness and not wanting to be above neutral, we think that it's going to be a pretty equal step down towards 3%. We have to think, too, the Fed leadership, there's going to be a substantive change here in the first half of next year, and we know what the bias of that policy is going to be.
Yeah, pretty clear, and that is lower rates for sure. We look at the two-year yield at the lowest in more than 3 years, Steve. The 5-year yield sinking to 3.5%. The 10-year yield falling below 4%, the lowest since early April. If you're going to buy bonds, where do you want to be on the curve?
You want to be a little bit more mixed now. I think longer term, we still expect the curve to steepen. Priya highlights that the lack of the flow through in the data, frankly, on the Sell America trade, it hasn't happened. Some of the data we will actually get is later today, the latest release from the Treasury, the tick data showing foreign flows, which we expect to again be positive. We're seeing them as positive through our franchise. So we're seeing pretty balanced demand across the curve. New issue supply is being digested. There's still strong demand technicals, especially in high grade credit. So we're still biased for a little bit of a steepener, but we've expected a range-bound level for interest rates. When you look at the 10-year, we broke through 4%, as you said. That to us was a mini signal to reduce a little bit of our duration and flatten out exposure a bit. But we still think bonds provide upside participation if you get some risk off elsewhere, and then they have a still high level of yield, and yield's the biggest predictor of future returns.
Steve, before we let you go, I want to get your take on the one official data that we will get next week, and that is CPI. How are investors, how is the market positioned for that?
I think it's a secondary consideration for now. The market's being driven by labor market potential imbalance. We're obviously not getting data there. It will be helpful, but with how trade policy, tariff policy is evolving, and frankly, our view that you should continue to see disinflation absent any noise there, which is mostly showing up in the goods section. We don't think it's going to be a market-moving event. The Fed seems predetermined for now to get back towards a neutral state, and that's because of the state of the labor market, less so on inflation, which they still don't know how to think about medium or longer term.
They still don't know how to think about it. I like that. Steve Brown, thank you so much.